Good to have you back. What do you make of those jobs numbers today? Are they too hot? Are they sustainable? What do they tell you about the state of the economy and what we should expect?
Yeah, I think it kind of reinforces this message we've gotten all year in this last month of the year that this soft landing is still on the table. With an unemployment rate at 3.4%, a recession is clearly not imminent. Now, the other part of the story, which I think is supportive as well, is that wage growth figure. So at 4.6% or so, Jerome Powell told us on Wednesday he's looking at three buckets of inflation. Goods inflation, that's come down. Housing rental inflation, that's showing signs of weakening. And then, of course, this wage growth component, that's been a little bit stickier, but we're starting to see signals that's coming down as well. So certainly better inflation numbers have been driving this market as well.
Ron, walk me through the week as you review it and as you look forward. What did we learn this week about the Fed, about the economy, potentially about the future? And I'd like to have a comment or two from you about the state of liquidity in the market right now.
Well, liquidity seems okay, Tyler. I mean, we're not hearing as many complaints about bond market liquidity as we have in the past. Certainly, there's some cash on the sidelines that's been driving equities higher. With respect to the current state of affairs, Jay Powell himself said that we're entering a disinflationary environment. And as Mona suggested, the rate of wage inflation is beginning to slow. It was up 0.3% for the month, 4.4% year over year, which is down from 4.8%. And if you annualize a 6-month rate of inflation, wages are growing faster than inflation. So there's no danger of a wage price spiral. And I think that's what we learned this week. And I think the markets seem to be digesting that reasonably well. If anybody was in the bond market was losing their minds over inflation, you'd have a much higher yield on the 10-year note than 3.5%, particularly with the Fed engaging in quantitative tightening. It's selling bonds, and bonds aren't really ripping to the upside in terms of yield as a consequence of these data.
Mona, I mean, all of this, though, I didn't realize it's a down day for the markets, but for the most part, it's another up week for the major averages. And since the start of the year, I mean, the Nasdaq's up 15% since the start of the year. Have we moved too far too fast, given the fundamentals?
Yeah, it's a valid question. Look, everything that underperformed last year is ripping higher this year. And that's not only the Nasdaq, parts of the Nasdaq like comm services, consumer discretionary, up 20%, so back in bull market. And we've talked about the speculative parts of the market, some of those ARK funds, some of the Bitcoin complex, all up 40% plus. So there is a valid question that investors are asking, are we moving too far too fast? And as we know historically, markets don't go up in a straight line forever. And in fact, when we move up this fast, it does tend to leave the market a little bit vulnerable to downside shocks. And so what are some of those shocks that could happen? Well, maybe it's earnings again. If you look at earnings expectations, in fact, for Q1 and Q2, back-to-back negative quarters expected. So maybe that also translates to GDP to some extent, but certainly we're getting sort of an earnings slowdown ahead of us. But maybe on the good side, when January is this strong, historically the year does do well as well. So as goes January, so goes the year.
Ron, let me come back to liquidity for just a moment. Yeah. I guess one observation might well be that one of the reasons we had such high inflation is that we had really high liquidity in the market. We had the Federal Reserve injecting cash into the market. We had the fiscal stimulus coming into the market. We had all of that spending. That seems to have abated a bit. But let me ask you this. There were a lot of people who said we can't get inflation under control until real rates are positive. Are we there yet? And how
positive.
Yeah, they are. And how sustainable is that positivity?
Well, I think it's going to stick for a while. What's going to drive inflation in the second half of the year? Almost immediately after Jay Powell said disinflation on Wednesday, you had a cohort of economists come out and say, the second half of the year we're going to see rising inflation. The question is, where does it come from? China reopening? Maybe, maybe not. Energy? Clearly not. It's falling even amid worries of another offensive in Ukraine by Russia. And yet all energy components are down sharply this week, with Europe having stocked up on natural gas that could carry it through all the way through next winter. It just doesn't seem to me that many people are thinking about this in a nonlinear fashion. It seems like some very linear thinking going on and just extrapolating old trends into this year. I don't see any further increases in inflation. I don't see any inputs for those. And so I think to answer the first question that you guys raised was, I think slightly higher rates and a stronger economy is better than the alternative, which would be a collapsing economy and plunging interest rates. That would not, it might be good briefly for the markets, certainly wouldn't be good for the economy or for the average American.
So quickly, Mona, where would you be putting money to work right now?
Yeah, great question. Look, I think if we do get any sort of pullback period of consolidation, that is really the opportunity, especially if you missed maybe this last month of rally, to put money to work. And what we'd say is take a balanced approach, quality growth, cyclical parts of the market. Those are recovery plays, small caps over large caps. But longer term, that value trade with rates this high and probably not going back to the zero bound, important to have that diversification element in there too. So use those pullbacks as opportunities. We do think there's a period of more sustainable recovery coming ahead.